You want to learn how to invest? Welcome to the jungle. One expert tells you, buy gold. The next one, gold is dead. A third one swears only by crypto. The fourth calls it a scam. And you, in the middle of all this, paralyzed, unable to decide. That's normal. When everyone contradicts each other, impossible to know who to believe. And it never stops. Monday, real estate is exploding. Wednesday, tech stocks, it's now or never. Friday, some unknown crypto is going to revolutionize everything. You feel like you're missing the train? That's exactly the point. This artificial pressure pushes you to decide in a rush. But rushing is the investor's #1 enemy. Stop. Before investing a single dollar, one question. Do you have a safety reserve? 3 to 6 months of expenses, accessible immediately. Not in a locked account, not in stocks, in available cash. Why? Because life strikes without warning. Car breakdown, job loss, medical bills. Without this cushion, you're vulnerable. With it, you're at peace. Imagine the worst-case scenario. Markets are crashing. And then, boiler breakdown, $1,600 to pay out. Without reserves, what do? You sell your stocks at the worst moment, at a loss. This is exactly what sinks beginners. Your emergency fund is your freedom, the freedom to wait for markets to recover. Remember that. A money market fund. What exactly is it? An ultra-safe investment, period. It invests only in secure assets, treasury bills, in other words, loans to governments, short-term bank deposits. The return? Modest, close to the key interest rate. But the risk of loss? Almost zero. And that's precisely what we're looking for with our reserve. But here's the real advantage: availability. You need your money? A few hours is all it takes. No delays, no penalties. That's why many investors use money market funds as a temporary parking spot. Your money waits patiently, it earns a little, and the day an opportunity comes along, you're ready to pull the trigger. Stable job, regular paycheck, aim for 3 months. But be careful, not 3 months of income, 3 months of expenses. Crucial difference. Get your calculator out. Rent, groceries, bills, transportation, add all that up, multiply by 3. There's your target. It's not sexy, it's not exciting, but it's what saves you when everything falls apart. Now, if your income is a roller coaster, it's different. Freelancer, entrepreneur, commission-based salesperson, you need more, much more. Aim for 6 to 12 months of expenses. Why? Because you can find yourself entire months without a single dollar coming in. The more unpredictable your income, the thicker your cushion needs to be. It's mathematical. What if you could buy hundreds of companies in a single click? That's exactly what an ETF does. A giant basket. Dozens, sometimes hundreds of different stocks. You buy one share and boom, you instantly own a fraction of each company. No selection to make, no headaches. Simple, incredibly effective. And here's the genius of it. One company in the basket goes bankrupt, the others compensate. Automatically. You have nothing to monitor, nothing to rebalance. The system does the work for you. That's what we call diversification. With an ETF, it's built in from the start. You sleep peacefully while your money works. Large cap ETFs are the choice for peace of mind. Apple, Microsoft, Nestle, giants. Companies that have existed for decades and will still be around in 30 years. They absorb crises. They always bounce back. For a 20 or 30-year horizon, it's often the most reassuring choice, and also the most profitable over time. But maybe you want more excitement. Technology ETFs bet on innovation, the companies transforming our world. The growth potential? Higher, yes, but volatility too. Prices skyrocket, and sometimes they plunge just as fast. Your stomach needs to handle it. This choice is for dynamic profiles. Are you one of those? Buying individual stocks, that's choosing your companies yourself. The potential for gains is higher, certainly, but so is the risk. A single company can collapse overnight, minus 30% in 1 week. It happens. This approach requires time, knowledge, and above all, nerves of steel. Are you really ready for this roller coaster? To succeed here, forget gut feelings. You need a method. Analyze each company rigorously, its revenues, its debt, its market position. Seasoned investors never make exceptions to this rule. Never. This discipline is what separates winners from those who lose their shirts. You want to play in the big leagues? Play by their rule. And now, something different. Income investments. The principle? You receive money regularly without ever selling. Your stocks pay dividends, your bonds generate interest, your properties produce rent. This money lands in your account every month, every quarter. And meanwhile, your assets remain intact. They keep working. This approach becomes crucial when you're approaching financial independence. Why? Because you need predictable income to live, to pay your bills. You can no longer afford to wait for markets to recover. Dividends keep coming even when prices drop. It's a stable source of income. And that's where everything changes. Dividend ETFs? Ultra simple. Every quarter, money lands in your account. Automatically. You don't have to do anything at all. Let's take a concrete example. $11,000 invested. A yield of 3 to 4%. Result? About $385 per year that fall on their own 4 times a year without lifting a finger. But wait, here's where it gets really powerful. Instead of spending those dividends, reinvest them automatically. Your dividends buy new shares. These new shares generate their own dividends, and so on. Year after year, your capital accelerates. It's the snowball effect. Small amounts today become large sums tomorrow. And that is magical. First step, non-negotiable, protection. Before seeking gains, cover your bases. 3 to 6 months of expenses in cash. Experts are unanimous on this. It's not exciting, I know. It's not what makes you dream, but it's what saves you when life decides to test you, and it always ends up testing. Your protection's in place? Perfect. Now look at your horizon. 10 years or more ahead of you? Go for growth. Stocks? Yes, they're volatile in the short term, but over 20 years, they crush practically all other investments. The longer your horizon, the more you can absorb the bumps, and the more you'll come out ahead.